Good afternoon. My name is Joseph Davino. I will be doing a presentation on mutual funds versus ETFs, looking over the different features of each, trying to figure out if one or the other has disadvantages or advantages in different situations, and also figuring out what future research may look like. First, I want to go over a brief history of each type of instrument. Mutual funds have been around for quite a while. Some of the first closed-end investment companies were launched in 1822 by King William I. Also, a Dutch merchant named Adrian van Ketvich created a trust in 1774 that loosely resembled a modern-day mutual fund. However, the modern-day mutual fund was created by Massachusetts Investors Trust in Boston, and it was created in 1924. So they have been around for a pretty long time. ETFs are a little bit newer. So ETFs, or exchange-traded funds, haven't been around for quite so long. They've actually only been around for about 30 years. The first modern-day ETF was created on January 22nd, 1993. It was very popular, and it is still traded to this day. It's the S&P 500 Trust ETF. So that ETF is going to follow the S&P 500 index. All right, so let's move on to the actual meat of the presentation. All right. So mutual funds So first we'll go into the fees involved with each type. So mutual funds are generally going to have more fees. So the first type of fee is hiring costs, or the management fee. Many mutual funds are actively managed, so the hiring cost is generally to pay the managers of the mutual fund. All right. Then you've got distribution and service fees, which are 12B1 fees. 12B1 fees can come in many different forms. Usually used to pay marketing and distribution expenses. You've got account fees. Account fees are maintenance fees. So maintenance fees are usually charged on smaller shareholders who don't own a certain amount of the fund. And then there's loading fees and redemption fees. So loading fees are generally going to take place when you decide to invest in the mutual fund, and redemption fees are going to be applied when you decide that you would like to withdraw your money from the fund. All right, fees are one of the most common arguments when people talk about ETFs and mutual funds, because with compounding interest, even the small fees involved with mutual funds and ETFs can have quite an impact on your investment in the long run. All right, so moving on to ETF fees. So ETFs don't have quite as many fees, generally because of the way that they're traded. ETFs The only fees that you're really going to pay with an ETF is your broker fees. If you have a full service broker, your fees on a transaction can be pretty expensive. They can be $25, $50. Because with a full service broker, you're paying for professional advice, research, and a lot of extras that most people don't need. However, if you use a discount broker such as E-Trade, your fee is only going to be about $5. Most discount brokers that people use, the fees are generally $5 to $10. So it's really not that big of a deal when considering investing in an ETF. All right, so like I said before, when you're investing in anything, for a long period of time, you're relying on compounding interest to build your wealth. So naturally, the less fees, the more of your investment is actually going to compound, and the more wealth you're going to be able to build. So that's one of the main things that can go against mutual funds and can make them. It's one of their weaknesses is that the fees cut into your investment, and over time, the small fees can add up to be quite a percentage of your investment. ETFs, like I said, don't really have that issue. So moving on. So there's many different types of mutual funds. You have money market funds, you have large cap funds, small cap funds, mid cap funds, large cap growth funds. You've got I'm sorry. So you've got a bunch of different types of mutual funds, and they have different objectives. So that's a big strength for mutual funds. There's a lot to choose from, and it's pretty clear what the objective is. If you go on to, Vanguard or Fidelity or one of these other companies that handles a lot of mutual funds, whether you're looking for income, whether you're looking to grow aggressively, or whether you're, looking to have a long-term, relatively safe investment, you can find what you need, and they're all labeled. So even somebody who isn't really versed in securities can go through and kind of figure out what's going to be right for them. The analytics are really easy to find on mutual funds, so you don't have to do a bunch of math and looking at a bunch of different places to figure out how they work or how they're performing. Usually, like the Morningstar rating system, they're going to have everything right there for you. They're going to rate it from 1 to 5 stars depending on the performance. They're going to show you past performance. They're going to show you future expected performance, beta, deviation. There's a lot of information available on mutual funds. It makes them relatively easy to traverse. ETFs are a little bit different. There's ETFs. There's also a bunch of different types. So you've got your index ETFs. So these are they're gonna follow the S&P 500 index, the Russell 2000 index, the small cap index, that is. They have ETFs that follow the Dow Jones Industrial. So indexing with the ETFs is a really strong advantage because it's very simple, it's very easy. And indexing in general is an easy strategy. So a lot of people that want to use that strategy might choose to go with ETFs because of the ease of use. I mean, really, you just log on to your E-Trade or your Ameritrade or whatever you have, and it trades just like a stock. You enter the amount of shares, and you buy it. So it's relatively easy to execute. Sorry, that strategy using ETFs. All right. sector and industry ETFs. So they're going to a sector ETF is going to have a bunch of securities from one sector. So if you're talking about the oil sector, you can find an ETF that is going to track the most prominent oil securities, and kind of generally give you an idea of where the market on oil is going, which way it's headed, what the trend is. Same thing, gold. Gold has ETFs you can use to track the gold market. So a lot of traders will use these different types of securities, different ETFs, to hedge, because it makes it relatively easy. So say that you have a bunch of money invested in gold, and you think that the price of gold is going to drop. It's a pretty easy to go in and hedge using an ETF. You can short the gold index and maintain your long positions for tax efficiency and protect against some of that downside that the market might see, or that you think the market might see. So that's a big strength. Trading is a big strength with ETFs. Derivative ETFs. So derivative ETFs are a strength, but they're also very, very dangerous. So when an example of a derivative ETF would be like the VXX. So the VXX tracks the fear index, which is based on a derivative. It's based on options from the CBOE. So you're going to be able to track that, and the thing that makes derivatives scary, or especially the volatility indexes, derivatives based on that, like the VXX, is that they are. So you remember what these things are made up of. ETFs are a basket of securities. So with the derivatives, it's basically a basket of a derivative of the overall market feel. So if there's a lot of fear in the market, then that ETF, the VXX, is going to go way up. If there's no fear in the market, it's going to go way down. And the way that they're geared, some of these derivatives are ultimately, their intrinsic value is zero. So there's always the case where there could be a black swan event where those types of ETFs could go all the way back to zero. Just recently, we saw in February a volatility ETF go from $100 to $4 in less than 2 minutes. A lot of people lost a lot of money. So you have to be really careful with these things. You have to understand what they are, you have to understand how they work, and you have to understand what to use them for. But for a well-versed investor, ETFs are a better trading platform than a mutual fund, for a few reasons. And we'll get into more of that later. Alright, so you've also got inverse ETFs. Inverse ETFs are exactly what they sound like. So say you have an ETF for the S&P 500, all right? SPY. The SPY is an ETF for the S&P 500. There are inverse versions of that. So and they have different multiples. They have different leverages. So you could have an ETF that is an inverse of the SPY. So it would be a short leverage ETF, all right? And you could have 2 times, 3 times. I'm not sure if there are many that go over 3 times leverage. So basically what that means is that as the S&P 500 ETF goes up, the inverse ETF is going to go down, and depending on how much it's leveraged, it's going to go down in multiples. All right, so if it's a 3 times leverage, it's going to go down 3 times faster than the S&P 500 goes up, in theory. All right, so now that we've talked a little bit about the fees involved and the types of each security, we can go into actually what are some of the strengths and weaknesses of each. So mutual funds, they have strong active management, many of them. There are a lot of mutual funds, some the managers aren't as good, but generally you're going to pick a mutual fund because of the active management in a lot of cases. Of course, there are index mutual funds, but for now we'll just talk about the actively managed ones. Active management is an advantage because when you have an active manager, they're going to consistently readjust and diversify the portfolio. They're going to be able to react to different market conditions. If the market is forecasted to go into a bear market for a while, they can readjust the mutual fund and protect against some of that downside. Really, the advantage is having a very experienced professional manager at the helm, watching your money at all times, which makes a lot of people feel comfortable, and it can be a good advantage. But it's also important to remember that the market beats active managers around 80% of the time. So this is mainly going to be an advantage in a down market, because with the market beating active managers 80% of the time, you have a 20% chance of choosing a mutual fund that is going to beat the market at any given time during a sustained upward climbing market. Automatic dividend reinvestment is another strength of mutual funds. So that you have no additional transaction fees. You don't have to do any work. Your dividends are automatically reinvested. All right, so mutual fund weaknesses. So as we talked about before, one of the main weaknesses of mutual funds is the high expense ratios and sales charges. They're going to cut into your investment, and they're ultimately going to leave you with less money at the end of your investment period due to that. Active management can become a negative if it's abused. We have to remember that investing can be an extremely emotional game, and these managers are human beings. And human beings are susceptible to things like overtrading. Basically this is a condition where the manager will pick a position and change their mind and get out of that position, get into another position, get out of that. And what this can do is it's not tax efficient. So if you're jumping in and out of different positions within the year, you're gonna be exposed to additional capital gains tax that maybe you wouldn't have if management didn't abuse their ability to shift the fund's investments. Got into a little bit of taxes when we talked about management abuses. Tax efficiency is a big thing. An uncontrollable tax event can take place in the mutual fund. So that's what I was talking about when I was saying that managers can jump in and out of positions and kind of leave you holding the bag on capital gains tax. As if you don't hold that position for more than a year, then your capital gains tax is going to be increased to basically what your income tax rates are, instead of the 10% capital gains tax. All right, big weakness of mutual funds for traders is that they can't be traded intraday. So for somebody who doesn't know what this means, intraday trading is basically between the hours of 9:30 and 4 p.m. It's when the United States stock markets open and close. Between those hours, mutual funds cannot be traded because mutual funds are based on NAV. So they're based on net asset value. And what net asset value is the price of the mutual fund is based on the cumulative value of all of the securities within the mutual fund. So if you have 4 stocks in the mutual funds portfolio, and each of those stocks is worth $5, then your NAV is going to be $20 plus any fees. All right, so NAV is settled at the end of each day. So at 4 o'clock, you'll be able to go in once the NAV settles. You'll be able to go in and purchase or redeem a mutual fund, but you cannot do it during the day. So you can't go at any time and just buy a mutual fund. All right, ETF strength. Talked a lot about trading as a strength of ETFs. And we talked about how mutual funds cannot be traded intraday. ETFs can be traded intraday, and that's because their value is not based on NAV. The value of an ETF is based on supply and demand in the market. They're traded on the secondary markets between the hours of 9:30 and 4. Of course, there is extended hours trading, but for this presentation, we'll just stick to the regular market hours. So they're traded between the hours of 9:30 and 4. And they're traded like a stock. They trade just like a stock. So you can go in at any time and you can buy or sell an ETF. They vary in liquidity. So, but most of the popular ETFs, you're going to be able to go in at basically any time. Using the SPY as an example, you can go in any time. You could buy 50,000 shares if you wanted to at the snap of your fingers. So it's very liquid. They're very easy to trade. They're able to be traded at any time during the day. They have low expense ratios. Like I said before, the fees only consist of your basic broker fees. Discount brokers would be $5, $10 maybe. There's a huge variety of ETFs. So basically anything that you can think of, anything that you want to trade, anything you want to invest in, you can find an ETF to track it. So if you're a big gold investor, you can find an ETF to track that. If you're a steel investor, you can find an ETF for that. Marijuana, really anything. Oil, there's ETFs for everything, which gives them not only the ability to be used for hedging and trading and stuff like that, but it's also going to help investors track other investments. Because when you have underlying stocks, so say you have a bunch of gold stocks and you have a gold ETF, they tend to pull each other. So if generally gold is going up, that you'll be able to watch the trend in the gold ETF and have a good idea of if your gold investments are safe. If it's in a downtrend, you'll have a good idea. Maybe it's time to exit, or maybe it's time to buy more, depending on what your strategy is. They're not as strong. ETFs aren't as strong for fixed income as mutual funds, partly due to the fact that they do trade intraday according to supply and demand. They are tax efficient. So when you're using ETFs, like we talked about with mutual funds, how you can't control what the managers do, and that can result in an uncontrollable tax event. That's not going to happen with ETFs. You have full control of when you buy and sell the ETF. You have full control of timing your investments so that they fall within the IRS's rules for capital gains tax. So you can pay as little tax as possible, which is one of the goals of investing. ETFs are, and this might be more of an opinion, but they're easy to understand. Let's just stay away from that. All right, some of the weaknesses of ETFs. ETF intraday trading might not be necessary for long-term investors. So it's really not a strength or a weakness for some people. The intraday trading is more of an advantage for traders more than investors. Spreads can be very large. If you're dealing with a very popular ETF, I've used this example a few times, the SPY, the S&P 500 ETF, you're never going to worry about spreads. It's always, the spread is generally always going to be very close together, 1 cent apart. But if you're getting into some less popular ETFs, the spreads can get pretty large. And what this means is that the bid and the ask are going to be very far apart. So the ask could be at $3, and you buy it at $3, but the bid could only be at $2. So as soon as you buy it, you lose $1 if you try to resell it immediately on the bid. So you got to be careful when you're dealing with ETFs. Pay attention to the level 2. Pay attention to what the ask and the bid spread is, and if it's pretty wide, invest at your own risk at that point. All right, so trading, and let's look back at and do a direct comparison to some of the things we talked about. So the trading and liquidity of ETFs is one of their big advantages. ETFs trade in the secondary market like a stock. Their pricing is based on supply and demand. And then your mutual funds are not traded on the secondary market. So that's one of the biggest differences. And pricing is according to NAV. So that's one of the bigger differences between the two types of securities is the way that they're priced and the way that they're traded. Taxes, like we spoke about, ETFs have a tax advantage. You have more control you have complete control over your investment with an ETF, whereas with a mutual fund, you have a manager who is adjusting and diversifying the portfolio as the market conditions develop. So ETFs have an advantage when it comes to trading, tax efficiency, and cost. Mutual funds have advantage of being diversified and managed by professional managers. Mutual funds also have the advantage of being around for a very long time, so they are there's a lot of information available about mutual funds, and the system is pretty easy to use. Basically, all you have to do is search for mutual funds, and various companies will come up with their own products, and you can go through and it's pretty easy to find what you want for any situation. All right, so the main advantages and disadvantages of mutual funds and ETFs have to do with the costs and generally the way that they function. Future research. So we'll go into future research. ETFs have not been around for that long compared to mutual funds. So one of the things that I've seen a lot of the most recent research being done on is the balancing and the accuracy of ETFs in high volatility markets. One of the first really big market shifts that took place since ETFs were invented was in 2008. And a lot of the ETFs started to have tracking and balancing inefficiencies. So basically there's so many transactions that after the market closes, the ETFs need to be rebalanced. And so that's one thing. And I think that there needs to be, I think future research is going to show a lot more in-depth comparisons between ETFs and mutual funds because they are so similar. Having a bigger sample size, when we talk about things like, when we talked about earlier that the markets outperform active managers 80% of the time. So I think continuing that research and having a bigger sample size through different market conditions is going to help determine if that number is really that high. Because since ETFs have been invented, like I said, 2008 was a big test in basically a market crash, and also the dot-com bubble bursting was another test, not quite as big as 2008, but ETFs have seen a lot more bull markets than they have bear markets. So, and bear markets are one of mutual funds, because of the active management, they're one of the things that you could point to a mutual fund and say that it could have an advantage in a bear market. So getting more data, more information, under more market conditions, maybe another sustained bear market, may help to determine whether that 80% number is really truly accurate across all market conditions. Because that's a big question. If you can simply put your money in an index and you have an 80% chance of beating, highly paid advisors and managers, and this can be proven through prolonged research, then really what is the reason to have a manager? So I think we have to see if that 80% number holds true over the next number of years. So thank you for your time. I hope that I was able to explain ETFs and mutual funds a little bit better for anyone who is not versed in these types of instruments, and have a good day. Thank you.